Well, good morning, everybody. Thanks for tuning in today. Let me stop sharing and so we can have a mano a mano conversation here, person to person. First of all, I hope you had a great weekend. I hope you enjoyed the Super Bowl, no matter who you were rooting for. The halftime show was, I thought, one of the better ones, but then the previous ones weren't all that great, but I did enjoy it. My son, David, was not so happy with the Super Bowl. Back in the summer of last year, he bet $100 on the Bengals. Remember, this is the summer of last year. And the odds were 12-1. So he was hoping to have $1,200 in his pocket once the game was over, but that didn't work out quite the way he expected. But it was a pretty good call. It was a pretty good call, close call, but no cigar. Hope you're all having a great Valentine's Day as well. So enjoy that. Valentine's Day also has a bad mark in history as being associated with the St. Valentine's Day massacre. I don't think we're going to get one today. It doesn't look like Putin is going to be invading the Ukraine today, maybe tomorrow or Wednesday, or maybe never. We'll talk about that in a second. And the other possible source of a massacre would have been if the Fed decided to launch an emergency increase in the interest rates. And it just so happens that at 11:30, the Board of Governors, not the FOMC, but the Board of Governors will be having a meeting to discuss the discount rate. When I first saw that last week, I was wondering what that's all about. Turns out it's a pretty routine matter that they get together for on a regular basis. I would imagine that they might set the stage for raising the discount rate by as much as 50 basis points at the in concert with what I think will be a 25 or 50 basis point increase in the Fed funds rate at the March 15th, 16th FOMC meeting. Well, let's talk about Putin for a minute here. My hunch is that Putin's making a lot of money here in the oil futures market. He certainly knows how to push the price of oil up. All he's got to do is start to rile things up in that part of the world, and the price of oil goes up. I guess when and if the price of oil takes a big dive, Putin will probably have shorted that market on the inside information that he would have that some sort of deal has been worked out to avoid a military confrontation in that part of the world. I don't know what he's going to do. I know that we all know that he's got ambitions to put the Soviet Union back together again if he could. But I think he's certainly getting some significant pushback from NATO. I think he was hoping that this would also kind of spin NATO into disunion. Instead, it looks as though it's actually bringing NATO countries closer together. And the unintended consequences for his approach here is that NATO might be even more unified and up its budgets for defense spending and actually put in more equipment and soldiers on the front lines of countries like Poland. So it's still I guess it's a Game of Thrones, and while Putin's playing that game, he's getting rich. And so if you're kind of wondering how can Russia afford having 100,000 soldiers just sitting there in the cold on the Ukrainian border, keep in mind that he's watching the price of oil on his screen the way we are. Now, the other issue here, of course, is the Fed, and Fed President, St. Louis Fed President Bullard has been rocking the boat here quite a bit. We're all expecting to see an increase in the Fed funds rate at the March 15, 16 meeting. Bullard's upped the ante and said that as far as he's concerned, inflation may be accelerating. He said that this morning again, so he wants to make sure that his message is being heard. He did get some pushback last Thursday when he basically said that the Fed should move 100 basis points by July, implying something like a 50 basis point at the March meeting and then 225 basis points after that, or some combination thereof. That certainly got the stock market riled up. But then again, he can't seem to let it go and decided to rile it up again this morning. But the market's pretty well discounted that the Fed's going to be raising interest rates real soon. His discussion about the runoff, it was basically that he'd like to see the runoff start, but he said nothing has really been decided. All of Bullard's hawkishness, increasing hawkishness, is clearly justified by the persistence of inflation. Inflation remains a serious problem. It turned out not to be transitory after all, and the longer that it's taking the Fed to get moving on going from easing to tightening, it hasn't really even started stopping the easing that they've had. They've been buying securities right through January. There's not much sense that they've stepped on the brakes yet, but they will in March, and they'll stop buying. But the longer it's taken them, the more we have a problem with inflation, not just being persistent, but maybe even accelerating. And the risk, of course, is a wage price spiral, and it's not just a risk; it's happening. We've seen, for example, the two of the largest employers in the country, Walmart and Amazon, have been raising their minimum wages. They did that last fall. Amazon's raising its minimum salaries. Did that earlier in February. And so think about that. Walmart and Amazon were the two most important contributors, among the two most important contributors to disinflation over the past several years. They brought a lot of cheap goods made overseas with cheap labor to the United States. And that was a major contributor in bringing inflation down and keeping inflation down. Now what they're doing is they're actually not setting low prices. What they're setting is higher wages. And as we saw, Amazon announced that they're increasing the price of their Prime membership. And I'm sure Walmart will one way or another figure out how to pass through its costs into to prices if they can't offset that with productivity. And let's face it, both these companies are extremely productive companies. So if they have to keep their margins, they're going to have to do it by raising prices. And then inflationary expectations. You know, it's crazy, but only a few months ago, Powell and other Fed officials were still contending that inflationary expectations were well anchored, was their expression, well anchored. Pretty clear that that's not the case. We know that the Federal Reserve Bank of New York's own survey of consumers is showing that over the next year, consumers are expecting a 6% annual inflation rate. And over the next 3 years, they're expecting 4% at an annual rate. And that's 4% is twice what the target is. So we continue to have an inflation problem. The bond market is finally acting somewhat normally, though you know, if we're talking about a 2% bond yield when the inflation rate is somewhere between 5 and 7%, with the hope that it moderates. I have that same hope, by the way. I'm not totally giving up on that, but I'm watching the data, and the data that we got for the CPI shows no evidence that inflation is peaking. There's still some evidence that if you look at the 2-year percent change in the CPI component inflation, that some of this is still a base effect, reflecting the fact that prices were very depressed in the initial phase of the pandemic. But again, you really have to kind of stretch to come to that conclusion. There's more evidence that this thing's spreading. And even Bullard this morning said that he was concerned that inflation is accelerating. So those are the issues to contend with. The bond market at 2% makes sense to me. At 2.5%, it'll probably make even more sense to me. And I think we'll probably get there by the end of the year. What is still kind of strange is the yield curve. The yield curve, as you know, has been narrowing. The spread between the 10 and the 2-year has been narrowing. There's no point in looking at the 10 and Fed funds rate. We know the Fed's way behind the inflation curve, as evidenced by the fact that the real federal funds rate adjusted for the CPI is the lowest on record, the most negative it's ever been, even more negative than it was in the 1970s, when it was basically negative during that entire decade. So the yield curve, it's kind of strange because it if you interpret it as suggesting that a recession's coming, I guess it makes some sense. But we don't really get a good signal out of that yield curve right now because the Fed has continued to support the Treasury market. It's continuing to buy securities, including bonds. So I'm not sure what to make of it, but I do know that I'm getting more questions about it. And the more that it narrows and seems to be heading towards inverting, the more anxious investors get about the possible recession. And I'll be addressing that issue in, Debbie and I will be addressing that issue in the morning briefing tomorrow. We'll look at what the yield curve is saying and give you our opinion in a piece tentatively called "Yes, We Have No Bananas." I think some of you folks that have been around as long as I have know what that refers to, but I'm not going to give it away. Stay tuned. Stocks volatility seems to be in fashion these days. So it's a good market for traders. It's a good market for stock pickers. Momentum trading is over. And so that it is what it is. Doesn't mean it's a bear market. We probably saw that low made a couple of weeks ago on a Monday on an intraday basis. So I think it's more of the same, a lot of sideways volatility. Earnings still look pretty good, very good. And the valuation is certainly a source of volatility as the bond yields go up. Sectors, well, energy still looks quite good, especially to Vladimir Putin with what he's doing. Might as well stay with his bets on higher energy prices for now. Even without a military confrontation, we're likely to continue to see geopolitical volatility in that part of the world, including the Middle East, which is always prone to volatility. So energy makes sense. The climate change activists have been very successful in forcing fossil fuel companies to cut back on capital spending. So from the perspective of those companies, it's not such a bad deal. You cut back on capital spending and you watch consumers wanting more fossil fuel and not getting it because you're not investing in producing it. And you get higher prices, and so you get great cash flow and you get great profits, and your stock prices go up. And as we know, the best performing sector in the market so far this year has been, in fact, energy. Let's take a look at some of the charts that are in the morning briefing, which basically just lend some support to the points I've just made, and then we'll open it up for some discussion. So here we got the price of Brent crude oil. And as you can see, it's had a remarkable recovery. It's back to where it was in 2014. Back then, remember, there was an apparent bursting of the commodity super bubble. At least that's what that was called, and oil prices took a dive. But now we're back getting close to where we had been for quite some time a few years ago. I don't know that we're going to 100. I guess if there's an actual military invasion by Russia of the Ukraine, things get pretty messy, as wars tend to do, then perhaps we're talking about that kind of spike. And then, of course, that'll get even more jitters about the potential for a recession, because we've had lots of experience where spiking oil prices have coincided with recessions. Whether they actually cause them is something we can discuss another time. But Russia accounts for 10.4 million barrels per day of crude oil production. U.S. and Canada are still above that at 16, and Saudi Arabia is 10. But there's with Canadian and U.S. particularly production not having rebounded to where it had been, given that oil prices are up. There's some concerns that the frackers in the U.S. may be starting to run dry on some of their wells, and that we're not investing enough to find more oil and gas here in the U.S. And so that means that we've become more dependent on rogue countries like Russia. But in addition, we're dependent on the Middle East. And so that makes for a gamey situation in the price of oil. Again, energy has been the clear outperformer in the, I hope you can see it, it's a little red dotted line here. Has been the clear, that's what the problem when you try to show a lot of data in one chart. but it's pretty clear that everything else has been sort of a so-so, if not an actual negative return, whereas energy has done really well. And I think that continues to be the case for the next several months. This just shows you the energy industries that have done well, and the answer is they've all done well. So here we have a chart that I've shown you before, showing the great inflation in the current situation. And there is a certain sense of deja vu all over again between what's going on now and what happened in the great inflation. You might recall last year, late last year, I think October of last year, started talking about two scenarios, the roaring 2020s and the great inflation 2.0, the great inflation 2.0 being sort of a replay of what we had in the late 60s and the 70s. And I assigned a subjective probability of 65% to roaring 2020s and 35% to the great inflation 2.0. I'm changing that to 60% to roaring 2020s and 40% to the great inflation 2.0. These are not scientific probabilities, they're totally subjective, and it's just a way for me to convey to you that I am concerned about the persistence of inflation. I'm concerned about the wage price spiral feeding on itself. Look, the great inflation of the 1970s was a combination of really bad policymaking combined with quite a bit of bad luck. And that's kind of sounds like what we're going through right now in terms of bad policymaking contributing to inflation and bad luck. We know that soybean prices have been taken off because of a drought in Latin America. We know that cattle prices have taken off because of a drought in the Midwest and the West, and so those are sources of inflationary pressures. And we know that oil is up a lot for reasons we've discussed, and then that does tend to have an impact on wages. And we've seen companies scrambling. And what's different this time is the labor market is much tighter than it was during the 1970s. So the pressure to raise wages anyways was quite intense. The hopeful story on inflation sort of moderating all by itself is that some of it is pandemic related. Nobody knows exactly how much. Just be honest with you here. The durable goods inflation rate has been a big source of the trouble, as you can see here. Even with the CPI, it's up 18.4%. Used car prices are up 50%. New car prices are up 12%. Bedding is up double digits. So furniture and bedding. So historically, or at least since the mid 1990s, these prices have tended to fall, and instead they've been going straight up. And one would imagine that as supply chain disruptions as the pandemic abates, big assumption, but I think it looks that way right now, those prices will start to, at least the rate of inflation will come down, and maybe at some point here it'll decline. You might want to know what happened to my 1940s scenario. Well, this is the 1940s scenario that when the soldiers came back from World War II, there was a tremendous demand for consumer goods that couldn't be met because everything was geared up for wartime production. So we had a huge increase in the price of consumer goods, and that's what we're seeing here. But then within a couple of years, production ramped up and everything was okay, and that inflation came down. So that's still in my mind quite relevant. Non-durable goods inflation, we discussed food and energy, and right now it's not looking good. But it is a volatile series, so sometimes when it goes up, the next thing it does is it goes down. Services, I think, is where we all agree there's a problem. That isn't going to go away, and that's rent inflation. And that's because home prices are up over 30%, and a lot of first-time would-be home buyers have been priced out. So here we got that CPI inflation rates for new and used cars. Here we have the CPI rent of sheltering. And you can see that's come back pretty dramatically. And compare that to what we had back in the great financial crisis, when we actually had rents going to zero on a year-over-year basis or declining. That's just not happening this time around. Meanwhile, as I said, energy prices are going up, gasoline prices are jumping, and that's depressed consumer confidence. I don't know if it's going to affect consumer spending, but to a certain extent, it's got to the extent that you've got to spend more on gasoline. Cattle futures, as we mentioned, there's a shortage of feed because of the drought, and so cattle futures have gone up, which has pushed up those prices. Soybean prices have gone up because of the drought. Meanwhile, the federal funds rate, at least in January, was the most negative it's ever been relative to the CPI. And again, in the 70s, we had a negative real rate, but this exceeds anything we had back then. So the Fed is way behind the inflation curve. And if we're lucky, the inflation curve will bend and the Fed won't have to raise interest rates that much, which is what the yield curve is saying. If we're not so lucky, then we have to consider the possibility, I don't really even want to talk about it, Volcker 2.0, but that's what happened in the 1970s, is it took a recession caused by soaring interest rates to bring inflation down. Meanwhile, the Fed has talked about inflation expectations of being well anchored. These charts suggest that's not quite the case. I don't know why I stuck that. Oh yeah. That was just to show where the Fed is relative to its inflation target. So you can see that here. The Fed on for the PCD was actually tracking 1.3% instead of 2%. Now I guess they could take some comfort that they're finally catching up here, but they've clearly overshot when you look at it this way. So that's my monologue. Let's open it up for some discussion here. Do you think? This is from Doug. Do you think James Bullard watched your interview on Bloomberg? Thanks for that, Doug. I did do a Bloomberg interview on Thursday of last week at 7:30 in the morning. And I said, the Fed should just get on with it. Let's just do 50. I said, I've written it. Let's just do 100. I mean, the market's expecting it. Let's get it over with, shock the system a little bit and see if that'll do the trick. And then, so that was 7:30, 8:30, the CPI comes out, and that was a shocker. And then by noon, I think, thereabouts, Bullard came on. I think he's an independent thinker, and I don't know that he was influenced by anything I said or even saw what I said. I'm hearing some parts of the supply chain are healing. Is that correct? And if so, in what way? Yeah, I'm not hearing it. I'm seeing it in some of the surveys, business surveys, on backlog of orders and vendor delivery times. Those indexes seem to be coming down, so that's a hopeful sign. I'm encouraged to see that car production in Japan soared in November and December, which suggests that they're getting the chips that they need to finish off cars. So I suspect the same thing's happening here. So there's some of that. Then again, who knows what's going on in China? They've got the Olympics going on. It's a police state. Anybody who gets questioned by reporters on the Chinese side always has an interpreter working for the Chinese Communist Party to make sure that everything is interpreted properly. But it is a police state, and one of the things that they respond to COVID is with police state tactics, and that's just zero COVID. They just shut down cities of millions of people. The problem with that approach is, at least for supply chains, is it affects them. It shuts down manufacturing of parts that the world needs. The other part of it, of course, is they just have a terrible vaccine that they've been using. It just doesn't work at all, which is why they have to continue with this zero COVID. But that also means that they haven't allowed the herding, for enough people to get infected naturally for us to achieve herding immunity. This is Jay. Everyone says Fed is behind the curve. How would they guess virus impacts? Omicron was as latest as December. It's a good question. I showed you a real simple chart for seeing this behind the curve. Look at the real Fed funds rate, and they're clearly way behind the curve in that regard. I think that the Fed made its original mistake in 2020, August 2020, when they officially gave more weight to the labor market than to inflation. And I think they continued to underestimate the improvement in the labor market all of last year. And we certainly saw that in the last 5 months of last year. The upward revisions turned out to be 1.4 million more jobs than they were aware of. So they overstayed their welcome. They should have known. I mean, we know even with all these variants that the supply of the availability of jobs well exceeded the the unemployed workers. So I think even if you give them some benefit of the doubt for the pandemic, I think they're behind the curve, and I think they need to catch up, and I think they know it. Okay, Tim, I saw several Super Bowl commercials for crypto last night. Could not help but think of the pets.com Super Bowl commercial in 2000. Thoughts? I completely agree. I don't want to spend much time on crypto because I don't spend much time on crypto because my basic view is they're digital tulips. So that's all I have to say on the matter in the short program that we have today. So let's move on. But thank you for that. What if we are now seeing peak inflation numbers and inflation would come down? Let me scroll down here. My mouse doesn't want to work. Oh, there it goes. What if we are now seeing peak inflation numbers and inflation would come down at a much faster rate during second half of the year while the market is not discounted for that move? Yeah, I've been entertaining that thought. That's been, you know, if I have had an official thought, it was that there were, you know, there were a lot of us thinking that a lot of the inflationary pressures were pandemic related, base effect related. But the longer it's persisted, the more it kind of feeds on itself. There's certainly a psychological element to it. There's a shortage of labor. There's bad luck in the food sector, beef prices, and so on. So I think that in your scenario, if we suddenly get a relief, I think that scenario, which I think was actually fairly consensus a few months ago, now is relatively contrary. So if that were suddenly to pan out, I think the stock market would jump for joy. Bond market might jump for joy to the extent that the Fed would have to do less in raising interest rates. So it's become a contrary scenario, and from that perspective, it's somewhat appealing. By the way, speaking of contrary scenarios, The Economist has a front cover story of a roller coaster, and implying that we're now going down big time. The story is obviously more balanced than the cover, but the cover is another contrary indicator. The things aren't going to completely unravel here, and of course that's not my position. But I'm still leaning in that the direction you just pointed, that we'll get some improvement in the inflation rate from as the pandemic abates. But then we've got the wage price spiral, we've got the rent wage spiral. So there's some issues here that we've kind of added to the equation that are going to keep inflation. Let's put it this way: if you're right, and if I'm right that consumer durables inflation comes down, that would be consistent with that. But we're not going to see, I think you'd agree, we're not going to see 2% inflation anytime, or under 2% inflation. The problem won't be to get inflation back up to 2%. It'll be to get it back down to 2%. And I think if it runs 3 to 4%, that's still pretty hot. But I think the Fed might actually move the goalpost and say, well, 3% is our new target. But that's just something to think about down the road. I think I got one more question here. Do I have a opinion on small cap stocks at this time? Well, I've had an opinion. Let me just keep scrolling here. We'll do a couple more questions. Yeah, I've had an opinion on mid caps for a while, for about 6 months. I've been thinking they're dirt cheap. Maybe it was the risk off and that people just wanted to invest in the S&P 500 or ETFs that invest in the S&P 500s, and the mega cap 8 dominated the whole story. But the mid caps, as I've said and written numerous times over the past 6 months, we've seen the stock price indexes of the S&P 400 and 600 go sideways, while earnings have been absolutely on fire. They've been much stronger than the S&P 500, which has also been extremely strong, V-shaped recoveries in earnings. And yet investors kind of ignored all that. So as a result, now we have, 13, 14 forward PEs on these mid caps. So if you're looking for cheap, you don't have to go and find it overseas. You can find it in the mid caps for sure. And the values are are doing relatively well, and I think they're more expensive than investing overseas, but at least you don't have the currency risk. And we're updating our piece for tomorrow on stay home versus go global, and there's more reasons than we've had in a long time not to go global, to stay home. That doesn't mean not invest overseas at all. It just means overweight the U.S. I'll take one more so I can just overstay my half an hour self-imposed time frame. Let's see. Paul, perhaps I have this wrong, but it feels like QE is more responsible for inflation than the Fed funds rate. Where do you think Fed funds needs to be before runoff starts? Yeah, this is the tricky part here for us as forecasters, as investors. It's even trickier for the Fed. I think they've started talking about runoff, but they haven't apparently really gotten into the weeds of exactly how you do it, at what pace you do it, and try to appreciate the extent to which it does or does not have an impact on credit availability and the economy, the stock market, the bonds, and all that. So I think it's pretty clear they're going to start raising. They're going to stop buying in March. They're going to start raising the Fed funds rate in March. I think it will probably be 50 basis points, unless we get a surprising improvement in the next CPI. And I think at that March meeting, they will discuss the particulars of the runoff, and they may actually announce it to the extent that they feel that they should get going with that as well. And I suspect it'll be some phased in runoff, because just doing the $1.1 trillion in securities that mature in the next 12 months would mean $95 billion in extra funds that need to be raised in treasury auctions, on top of the 80 billion that's not being purchased by the Fed. So I think that would be just too much of a shock to the markets. Well, look, you've all been very kind to join me today, and let's do this again next week. And I wish you all the best in the week ahead. Thank you.